Hi, in this session, let's talk about how we can limit your losses in trading. Sure, this is not going to be a cakewalk. For this to work, you must put in a great amount of effort. The only thing I can inspire you or guide you is to help you make a better decision on trades. There are enough videos on you can get on psychological aspect of trading and traders alike, but this one will focus more on the technical side of it. As deep breathing and calming mind would not bring any profit by end of the day, they do deserve a space in shaping your trading, but it's not all of it. This session will focus on two aspects, time and technical analysis. So let's start. A trader finally must make one of these choices: buy, sell, or do nothing. You can easily make a random choice by picking any, but if you are looking to make this decision continuously and want to make more right decision than bad ones, you will have to put in a system to make it happen. All this is working towards layering a risk management system on your current trading practices. Simply put, a risk management system helps you to make better decisions by not allowing you to go around making decisions based on the gut feel or heart. Your decision will be more statistic driven than by emotion. The first and easy dimension of trading to consider is time. We must precisely know the time we are in and understand it. For this, we must have an awareness of the following things: what month we are in, what week of the month we are in, what weekday we are in, what precise time we are in. Knowing the month will help us understand the generic volatility that can be expected. To learn this aspect of the financial instrument you are trading, you will have to look for the 6 months price graph of the instrument, 1 year price graph, 3 year price graph, 5 year price graph. By the end of this, you will start to recognize some basic patterns of price behaviors of this instrument. You can get this data usually from Google. Once you understood the generic behavior of the instrument during the month we are in, the next is to look for which week we are in. Usually, the first week of the month will be very active on volume and will produce a decent volatility. This tends to go down in the next 2 weeks, but from fourth and fifth week, or the third week to fifth week, the volatility will be generally high. The volatility is a friend to a trader. If we can understand it and use it for our gain, then we can be on the profit side. So the trades are preferable to be done from third week onwards than in the first or second week. In the first week, though there will be volatility, the basis for learning cues will be hard. We don't have that many cues available to know the direction of the market. But if you can zero in on a specific trade, then you can go at it. After the week, we must see which day of the week we are in. In general, Monday, Wednesday, Thursday are volatile, and Fridays are normal for volatility. Tuesdays are not recommended. Out of the 52 Tuesdays, maybe 70% of them tend to go as flat market. Once we understood what day of the week we are in, then we must look for the specific time we are in. Trading hours in India is between for equity 9:15 a.m. to 3:30 p.m. We can divide this session to we can divide this to three sessions: morning session, noon session, afternoon session. The morning session will be from 9:15 a.m. to 10:30 a.m. or 11 a.m. The noon session will be 11 a.m. to 1 or 2 p.m. Afternoon session will be 2 p.m. to 3:30 p.m. In general, morning sessions and afternoon sessions tend to be more volatile. The reasons are activity by all in initial hours is high. Then afternoon sessions will witness the block deals approved by exchange. These two sessions will tend to be more volatile than the noon session. But this is not an inclusive conclusion. At times, noon sessions can also turn out to be more volatile. So unless you are an option seller cashing in on the option theta decay or time decay, you should avoid trading during the non-volatile hours. The non-volatile hours are usually between 11 a.m. and 1 or 2 p.m. So let's reiterate what we did. We are analyzing the time we are in different dimensions of time: by month, then by week, then by weekday, then by a specific hour in the day. So by each we are narrowing our window to trade. If we are in the wrong window, we should not be trading. On the right window, it allows us to make more right decision. These windows are where asset prices are volatile. The assets means the instrument we choose to trade. Now let's talk about the technical analysis and why we should apply technical analysis at volatile hours. The core idea behind all technical analysis relies on the price, demand and supply in the market. It is on the assumption that the market behaves freely. But unlike the classic equation, which is the transaction between genuine buyers and genuine sellers, there can be a third party to the system in the capital market. They are called market makers. They'll be making the market active for trading even when there is no one to trade. They do this by providing two-way codes. This means that they are on the buy side as well as on the sell side, which in layman terms means they are the buyers as well as the sellers. So in most non-volatile hours, the codes will be from the market maker. Now coming back to the technical analysis, this works on the assumption that the market is free market. But when an asset is float on market maker's code, which means buy side and sell side is the same person, the technical analysis, be whatever it called, tends to fail as it is designed to tame the free market, not manipulated market. Hence, during non-volatile hours, avoid applying any technical analysis as the technical analysis fails to understand the manipulated orders. The manipulation of orders is legal since market making is part of how exchange operate. So concluding, we can say that apply technical analysis during volatile hours. Do not apply technical analysis on non-volatile hours. Now let's see how the decision of trading will be done. First we will see how the time, then we will go for the technical analysis, then we will be finally arriving at the trading decision. So end of the day, what we have done is we simply put layers of risk management methods to limit our bad trades. That limiting our bad trades also helps us to land on good trades. When you are applying this method to limit losses in trading, it also means smaller number of trades. So as for you to land on a good trade, you will have to pass right in a lot of control measures. This will help us to limit our bad trades.